Hey, this is Danielle. Welcome to the free video. So, as you may have heard, the S&P made new all-time highs today, coming in at a high of 29.58. Now, it was really interesting because on an intraday basis, the S&P did trade lower. I think it traded down about 20, 30 points lower or so before finding a bottom and then rallying back up and almost closing at the highs. So first of all, I will state that this is very bullish price action, okay? So all of this right in here, the way that the S&P rallied off the lows, this was a bit of a short squeeze, but the way that the S&P came and it held the 50-period simple, kind of creeping along until it took off the week of options expiration, all of that is bullish price action. So, in no way, shape, or form am I saying that the market's weak, that it's gonna, just roll over and die, nothing like that, because I do think that it's, forgot the H there. I do think that it's pretty strong, but the S&P also does have a history of pulling back once it makes that new all-time high. We saw it right here, saw it right here, saw it right here. And the most interesting part about this is the put-call ratio. So looking at the put-call, it's all the way down here at 0.58. So what does that mean? That's telling us that so many people in this market are long that at some point there's not going to be anyone left to buy. Now, the worst part about the put calls, it doesn't tell you exactly what day it's going to happen. It's just a heads up, okay? It says, hey, you need to be aware of the fact that a lot of people are along this market and there's not going to be too much more momentum to continue pushing it higher, but it doesn't tell you exactly when it's going to happen. So if you go back and if you look at the amount of times that the put call has been this low, you've got this high right here, you've got this high right here, you got this high right here. See, this one was really one. This one didn't work as well because we continued marching for another week and a half. But, moral of the story here is that this is typically what happens when the put call gets so low that there's no one else left to buy. You typically will see at least a pullback reversal to the mean. So, for me, what I want to do is I want to get prepared for that. And what does that mean? Well, it means primarily lightening up positions. I do think that in the longer term, the S&P can make the higher time frame target of 30.15 and then $3,100. But for right now, with the low put call, we already got through. This week of options expiration. Well, we have one more day, right? Tomorrow. What I want to do is I want to start getting some bearish exposure. Now, I want to do it in the SPX. I don't want to do it in the NDX because the modern day industrials right here, we haven't made that new all-time high. And I think that the NASDAQ wants the new high. I think that the NASDAQ wants for sure the 8,000 price point, maybe 8,100 before it rolls over. We are getting pretty overbought, but I don't want to add any hedges in the NDX because I think it has a little bit more upside. SPX, however, I want to start adding here. As you can see, we have expiration tomorrow, and what I'm looking for is just a very simple pullback reversion to the mean. So I like it at the 8 EMA, about 2,900. A deeper pullback would be all the way down at 28.77, but I don't think that we can... I don't want to bet off of that initially, right? So once the momentum shifts and we start trading lower, then okay, fine. Then I'll think about trading it back down to there. But at this moment in time, what I'm really targeting is the 8 EMA. And I also like the overlap confluence right here of the overall retracements back down to the downside, that if possibly we end up trading lower, we can target these areas. But for right now, I'm just looking for a very simple pullback back down to the 2,900 price point, 2,911 about, And I found a pretty cheap way to do that. I think that especially when you're adding a hedge when the market is making new highs, you don't want to have a lot of risk on because it could still keep chugging for a few more days before it rolls over. So I started off just a small position. I got a butterfly for $1.85 a contract. And this is a $20 wide butterfly. So you have very small risk for quite a lot of reward. So initially what I'm doing is just looking to trade it down about 20 points. I got myself 15 days on here. This would put it right before the July 4th weekend. So typically, and I'm sorry, not the weekend, but the week of July 4th. So typically you're going to see lower volume during a week like that, less trade. So to me, it would make sense that the market could potentially roll over before July 4th. So that's the first hedge I'm adding. I'll probably add some more, but that is the one that I wanted to share with you today. Once I get a little bit more confirmation, I will add some more. All right, so one more thing that I wanted to make sure that you're aware of is Henry, my favorite person to trade with, is doing a class this Saturday. You can find the information at simplertrading.com/pocket. So Henry is very, very excellent at pocketing premium. This is going to be a great class. I'm definitely going to be listening to it just like I listen to everything that Henry does. So make sure you come and check it out. He's had very high levels of consistency with this overall strategy. And this is a strategy that works really well in all different types of market conditions. So if you want to learn more, I will be there. Check it out. And beyond that, I hope you have a great rest of your day, and I will see you soon.